System Board meeting, November 11, 2020 at noon. And it's going to be an electronic remote participation via GoToMeeting. And we'll have the roll call. Chairman Calise. Here. Trustee Gordon.
Here.
Trustee Bovenstuff. Here. Trustee Novak.
Here.
Trustee Miller.
Here.
Trustee Hamilton.
Here.
And I'm here as well. Everyone's here today. It's fantastic. Shazi has alerted me that there's no public comment for today's meeting. Next is minutes from the October 21st, 2020 meeting. Can I get a motion?
So moved.
Support.
Okay, moved by Calise, supported by Gordon. Any discussion? Seeing none, let's take a vote. Chairman Calise.
Yes.
Chairman, Trustee Gordon.
Yes.
Trustee Novak.
Yes.
Trustee Hamilton.
Yes.
Trustee Miller.
Yes.
Trustee Bovenstuff.
Yes.
And Trustee Malzik, yes. Motion passes. We have 6 retirement requests this time. We have 5 from the PD and 1 from purchasing. Lisa, anything on these that is unusual or
Nope.
noteworthy?
Straightforward. Mhm.
Okay. Does anyone want to discuss this? Kurt?
Rob, just got a question. Being relatively new at this, why do we list the prior year government service for defined contribution? How does that impact the request for retirement or calculation of benefits?
Lisa, did you want to take that?
Yes, it just adds to the years of service to get you eligible for retirement. It doesn't really do much other than that.
Thank you.
Thank you. Okay, can I have a motion on these?
Sorry. So then I have
Trustee Miller?
a question, Lisa. So therefore, if you were unable to retire, you would not get the city's contributions, or is that already vested?
That should be already vested. It's just in this case with a DC retirement, it's just basically what you're eligible for payouts in retirement.
So just to clarify, because you're retiring, then you get other payouts that you would not get if you were just resigning. Okay.
It's sick time, basically sick time.
Okay. Can I get a motion?
I'll move to approve all the proposed retirement requests.
Second.
Support. Gordon.
All right. I had a motion from Bovenstuff and a support by Gordon. Any discussion? Okay. Roll call. Bovenstuff.
Yes.
Gordon. Yes. Calise.
Yes.
Novak. Hamilton.
Yes.
And Miller.
Yes.
And Malzik, yes. Item passed. Next on the agenda, we have regular business. We have our ERS board meeting dates. You see them there as posted. Again, they're the second Wednesday of the month, so it's the same schedules we've had in the past. Does anyone have any comments on that before we take a vote? Okay. Seeing none, can I get a motion and a support?
So moved.
So moved by Chairman Calise,
Support.
support by Hamilton. Any further discussion? Okay, we'll take the vote. Chairman Calise,
Yes.
Trustee Hamilton,
Yes.
Trustee Gordon,
Yes.
Trustee Bobensep,
Yes.
Trustee Novak, Trustee Miller,
Yes.
and Trustee Malzick. Board dates pass. Next item, ERS actual engagement letter for Gabriel Rodern Smith. Just wanted to point out that the engagement letter is basically the same as last year. It's the main fee is up a little bit, about 1.5%. And does anyone have anything they'd like to discuss on this?
Rob, have we changed the life expectancy? I believe that's one of the things we were talking about.
The mortality table?
Mortality, yes.
Yeah, at the last meeting, we updated the mortality table.
Thank you.
You're welcome. Any other comments? Okay, can I get a motion and a second?
So moved.
So moved by Chairman Calise and supported by
Second.
Trustee Novak. Any further discussion? Okay, roll call. Chairman Calise,
Yes.
Trustee Novak, Trustee Hamilton,
Yes.
Trustee
Yes.
Miller,
Yes.
Trustee Bovensep,
Yes.
Trustee Gordon,
Yes.
and Trustee Malzick. Item passed. Next item of business is we have a request for reimbursement to the city in the amount of $6 million in December 2020, $3 million each from Morgan Stanley and UBS. And just to give a refresher, we pay about $1 million a month in benefits. And since we are not making any contributions, we need to pull this money out of the fund. And we've decided to do this twice a year, in June and in December. So they fit nicely with our year end and also our fiscal year, our calendar year end and our fiscal year end. So we do not have any big due froms at the year end, and also gives a cadence that the investment consultants can understand and deal with. So does anyone want to discuss this item? No. Okay, can I get a motion and a support?
So moved.
So moved by Bovensep. And a support?
Support. Gordon.
Support from Gordon. Any further discussion? Okay. Roll call, Bovensep,
Yes.
Gordon,
Yes.
Chairman Calise,
Yes.
Trustee Novak, I'll take that as a yes. Trustee Miller,
Yes.
Trustee Hamilton,
Yes.
and Trustee Malzick, yes. Okay, moving on to Greystone Consulting Review. Tim?
Can someone pull up the pages from the agenda packet? The first one I'd start with is page 21. So as we're getting to that page, what I was going to show you some slides on the market and also kind of speak to you about where we think we are from a market perspective and what's been going on here recently, because there's obviously been a bit of volatility overall in the markets. Keep going a little bit further. Right there. Oh, no, sorry, one more page, Rob. There it is. Good, thank you. So as you know, the volatility in the market kind of started to pick up a little bit in September, as we didn't finish out the third quarter necessarily as strong as we began. And I think a lot of that was some of the same risks that we saw come to a head the week just before the election. So as we saw it, there were three known risks and one that's maybe known but not as talked about. The first being the election itself. And there were all sorts of kind of horrible, theories on what might happen around the election. That was creating a bit of uncertainty, and markets do not like uncertainty. So that week just before the election, the market was down, I think, over 6%. It was one of the worst weeks we had seen probably since one of the weeks back in March. And it was around the thought process of what would happen and that uncertainty around the election. While we don't know with 100% certainty, we do have a president-elect at this point. And underlying just who is going to be the president or not going to be the president, I think that the market also took some comfort in the fact that it looks like we're going to have a split in Congress. So the House will remain Democratic and the Senate will remain Republican. And if you look back in history, whether it was a Democrat or a Republican in the White House, when you had a split in Congress, that's always been good for the market, because the market knows what policies have been in place and doesn't expect any radical changes from that as we move forward. So those, I think, have done a lot toward curbing some of that anxiety or uncertainty around the election. The second piece was what we were talking about before we even got on the call, that's impacting the city, and that is the rise in COVID virus cases. And while this was anticipated, it's still not easy to deal with, obviously. One of the things, though, that may have helped from the standpoint of that as a risk to the market was the announcement that came out on Monday that there was a vaccine coming through trials that was proving to be very, very effective. And that definitely had a major impact on the market, because then the thought process is it's not anywhere near on the horizon. It seemed a little closer than further away that we may have a vaccine to combat this virus. And that was welcomed by the market, definitely. The third risk that we saw was on stimulus. So you didn't see stimulus getting done prior to the election. That may have been partisan politics. They got close on a number, but they couldn't quite agree to anything. We think now, with the election behind us, that we're probably closer to getting some stimulus done than further away. And I think that took away some uncertainty as well. There'll be a slide in a moment that will touch on the fourth piece, I guess, that we're talking to our clients a lot about, and that is, if you've been watching the 10-year Treasury, it has started to move up. And especially since the election and some of those other risks or uncertainties that I just talked about have seemed to have moved in a more positive direction. So as of this morning, the 10-year Treasury was yielding 97 basis points. I know that's still very, very low, but it's much higher than where it was previously. And I have a slide in here to talk about that. But we think this, V-shaped recovery, as we're calling it, and things that have developed here more recently, leads us to why I'm showing you this page. You can see this year, in terms of sectors within the market, it's been a case of the have and the have-nots. Up until probably September, where maybe some of the technology and discretionary names came under some pressure, they have obviously had outsized returns relative to the rest of the market. Anything that was more economically sensitive, energy, financial, real estate, utilities, so on and so forth, not doing as well. We've started to see some of that change, and our expectation is, in the normal economic cycle, historically, if we get a recovery out of a recession where growth is stronger and inflation may be a bit more of an issue than it was after 08, 09, that you will see some rotation back to these more economically sensitive or cyclical areas of the market. Doesn't mean that consumer discretionary and technology may not fare all right. We just don't think they have as much upside in that type of market environment. So that's why I wanted to show you that page, and we've definitely seen that have an impact on portfolios, even as recent here as just the last week and a half. Could you go 5 pages forward to 26? Yep, right there, perfect. So one of the questions we get about equities is, are they too expensive? And you can see this blue line on here is talking about earnings revisions. And as you might have expected, they were revised down significantly in the first part of the year. Well, then if prices stayed up where they were and the market didn't pull back, stocks would have gotten really expensive, right? Because you look at stocks many times valuation-wise on a price to earnings ratio. With earnings expected to come down, prices followed suit and they came down. Now what we've seen is a big reversal of that. And you can see the earnings revision breadth has been very positive, back the other way. That in our minds supports that the general market is not too overpriced. We would say, as we've said before, there are certain areas of the market though that are pretty expensive, somewhat concentrated, and may have a little bit more risk to them as we go through this rotation that I was just talking about as well. Could you go forward 1 page, please? Yep. Oh. There it is. So I may have shown you this before. This is our economic data support of the V-shaped recovery. So I've mentioned that a couple of times. If you look at economic data surprises, you can see that blue line went down as low as it's gone on this entire chart, even worse than 08, 09, as we shut down the economy. And then as it started to reopen up, you could see economic surprises headed completely in the other direction. And this is, in our minds, probably one of the single best graphs to look at and say, all right, if economic data surprises are moving up that quickly, far outpacing anything we've seen before, that leads us to believe that we're going to see more of that V-shaped recovery rather than something more along the lines of what happened after 08, 09. Any questions on any of those slides so far? The next one would be page 32. And I promise this will be the last one. No, you got to go back into the slides. Yeah. There you go. One forward. There you go. So the one that we said might be a little bit of a, although people are talking about it, might be less talked about in terms of a risk to the market. And that is, it's our belief that U.S. Treasuries are one of the most mispriced assets. And so on this chart, what they're showing you is those are cyclical and defensive stocks, right? And you can see how they've moved up. They've moved up in anticipation of that recovery that we've been talking about. And yet, if you look at where Treasuries are, that has not been the case. We have not seen that adjustment. It is starting to come on. And our worry is anybody who's been out longer chasing yield or out further in duration because that trade worked earlier in the year, that bonds or fixed income may be challenged as we expect to see more growth, potentially more inflation than we saw after 08, 09. And that could, even if the Fed keeps short rates low, that could drive interest rates up on the longer end. And we have seen a pretty big move back up to 97 basis points on the 10-year Treasury. So more to come on that, but that's also in our minds a way to view. The higher you see that go, probably the more conviction folks have in the recovery. So things like stimulus, good announcements on vaccines, that will probably tend to push yields higher because that will mean for people that we're getting closer to the end of this and better economic data ahead. So that's the last slide I would talk to you about on the markets. The next slide I would go to is 44. And we can touch on performance, and I've got an update on performance through yesterday's close as well.
All
I
right,
think it's one more page forward.
Yeah, these slides don't have page numbers, so.
Okay, so if you could go one more forward, I think that would be right. Again. There you go. Back up one. So on that top line, you can see for the quarter, the recent quarter, you're up 6.19%. So after a very strong second quarter and first or third quarter, we've made an about face, and the portfolio is actually up 1.21%. That's a little bit behind the policy. I've got some better news on that as we would update through yesterday, but another strong quarter. The portfolio, making up some of that lost ground that we had in the first part of the year. And then if you have a pen or pencil handy, you can write this down. The portfolio at the end of that time frame, and we might touch on this later on, but the portfolio at the end of the third quarter was at 94,899,318. If you fast forward to yesterday's close, the portfolio month to date is up 6.76%. And that's where I said you're seeing definitely some of those worries or uncertainties subsiding in the market moving forward. It's up again today. We have seen some change in leadership as we've been going through that. I see that within your managers. Quarter to date, then, that puts the portfolio for the fourth quarter at 5.3, and year to date that puts you at 6.3%. And then the portfolio's value as of yesterday was 99,886,684. So we've seen some significant progress to think that, we'd be sitting here with close of business November 10th after the way the market started the first part of the year. And it really wasn't just the equity market. It was anything that was considered a risk asset came under substantial pressure there in the first quarter. But the fact that, you were disciplined, you did not panic. It's in very quick order here between second, third quarter, now what we've seen so far in the fourth quarter. Pretty amazing to think we're back in positive territory to that extent as well. So congratulations to you for that. The next page would be 49. So if you could maybe move 5 pages forward from where we are, that might help if there's no numbers on those pages. You want to keep going? It should be just the asset allocation page. Or no, maybe it's 92. Sorry, you're going to have to keep going quite a ways through all of that. Oh, back up. There it is, right there. Yep, perfect. Thank you very much. So if you look, this is the portfolio. I know it says of 11.2, but you can see where your equities are overall in the overall portfolio. If you look down below that, you can see your domestic equities. So there's definitely an overweight there and an overweight toward equities. Your international, you can see where you're at there, about 19.5%, around the target. I did not mention our views on international. I've maybe touched on this before, but they're fairly constructive. With the new administration that appears to have been elected, we're not expecting there will be as much trade and tariff talk. That should be helpful internationally. Valuations there are attractive. They've been doing stimulus there as well. And then the other thing that we've seen this year has been the dollar, which was so strong after the 08-09 recovery from the recession. We've seen it start to kind of move on down. And that should be helpful from an international perspective in terms of performance. So because of those factors, we would expect to see and have started to see some better performance in international. Fixed income, you can see where you are there at about 28% of the portfolio. Your real estate exposure, 1.5%. Now you can see where the value was there. That shows you how quickly we've moved up because you were at, just under 94.5 million. and you're up almost to 100 million now through yesterday's close. Okay? And then the last piece I had for you was a follow-up on some of the information that we provided to you from an asset allocation standpoint. So you would need to move forward about 4 pages, I believe. Perfect. And what you see on there is, and this is by way of a refresher, the current scenario, that's the way that you're invested currently, okay? The target is from your investment guidelines. And as we talked about, you've got overweights, you've got underweights in the portfolio versus that. But that's a way for us to say, okay, if we were right on the target of our investment guidelines, what would that look like? And then what we've done is we've given you 3 other mixes. And the middle mix is really supposed to give you a look at if you wanted to have a portfolio that was primarily in more of the traditional asset classes, that's what it would look like. And then you'll see later on what it would do in terms of performance and risk. And then the other 2 mixes bring on some more alternative exposure in portfolios. Because if you recall from the capital markets assumptions, what we saw is some of those alternative asset classes not only have expectations for higher rates of return over the next 5 to 7 years, but they also have a better diversification factor. And so they help to keep a lid on the risk within a portfolio as well. So we wanted to demonstrate that to you with those additional mixes. So if you could move to the very next page. And where it says strategic assumptions, that's really looking at over the next 5 to 7 years, where I can be candid with you. Capital markets assumptions for our firm and many other firms have come down in terms of return, and they've moved up in terms of risk, making it more and more difficult to asset allocate. But if you look on under the current scenario, you can see the rate of return there. It is higher than your target, but so is the risk level measured by standard deviation. So the Sharpe ratio is only slightly higher. They're about the same. So if someone asks me, are the overweights and underweights helping you? They are. They're getting you a higher rate of return. But what you'll note there is, especially over that 5 to 7 year period, they're not getting you a high enough rate of return to meet your investment assumption. Okay? And it's our job to kind of point that out. And if we didn't point it out, your actuary would, and they would say something about that, obviously. Now, if you move to that mix 5, the one that's in the middle, and that's where I talked about, it has nothing in alternatives, which would be actually a step back from where your current targets are. You have a 7% target to alternatives right now, but that would all be in the more traditional asset classes. Quite a great deal in equities, obviously. Well, what does that mean? The rate of return goes up to 6.5, so that's the good news. The bad news is if you look at your standard deviation, that moves up even from where you are in your current scenario. And that gets back to the fact that as you're using primarily those traditional asset classes, as we add more into them, it doesn't help diversify the portfolio as much. And so the risk level goes up. So what you'll note, though, is the return does go up enough that your Sharpe ratio is actually more efficient than where you currently are or under your targets. The problem would be, is that a type of mix that you want to have now, given the volatility we saw in the first part of this year, volatility we saw in, say, the fourth quarter of 2018, and are you comfortable with having that much in equities? It would be even north of where you are right now. Okay? Now, the other 2 mixes you can see, one has about 17% in alternatives. The other one has 28% in alternatives. Now, you do have exposure right now to an alternative in REITs, which would be included in those mixes, but there are a lot of other areas that you don't have exposure in right now that the asset allocation study would say could be helpful. And I'll just cut to the chase. If you look at the very last mix, not that this is what you might want to do, but it definitely would give you, I think, some thought around this. That last mix gives you an annual rate of return of 6.8%, the risk level drops to 9.9 from where you currently are. And that is the highest Sharpe ratio at 0.57 of any of those mixes. So what we've been telling other boards, including your volunteer firefighters board, is that our recommendation to you would be to get some education first around some of those other alternative asset classes. And the reason being is there may be some of those that you'll be comfortable with. There may be some of those you won't be comfortable with, but you probably won't know that unless you get a little bit of education around those. And then we need that input to be able to say, okay, you don't like particular asset classes, or you might be comfortable with others, and we can start to potentially utilize that within the portfolio. Some alternatives are very liquid and have lower fees. Other alternatives are not very liquid and have higher fees. But that's part of what you would learn by doing some education around some of those asset classes. It's what many of our other clients are doing right now to try to remedy this situation, which says, you know, if we stay where we are, unless we're willing to take on more risk, we're going to have a hard time reaching our investment assumption over the next 5 to 7 years. So I'll stop there for a moment and see if you have any questions or any input concerning the data I just shared with you.
Mark Calise, I do have some questions for you, please. The Sharpe ratio and all the different jargon that's being used may be helpful to you in the investment community. I think that there may be a unjust, I don't know if we all understand what you're talking about. Having said that, I do have a couple other comments. Are you hired to oversee or to allocate for both you and UBS?
So I heard two questions there. Let me touch on both of those, and I'll apologize on the first question. Sharpe ratio, for me, because I'm a straightforward common sense, I don't like buzzwords, as you're probably alluding to, is it just measures the efficiency of a portfolio. For the amount of return that you get, how much risk do you have to take to get that? And the higher that number is, the more efficient that trade-off is between return and risk within a portfolio, okay? So that's why when we look at that, I say your current mix has a little bit higher Sharpe ratio than your targets, but some of those other mixes to the right are a little bit more efficient because that Sharpe ratio number goes up, the trade-off between return and risk. Now, to answer your second question, that's pretty easy. No, we do not. The advice that we give you is concerning the assets that we're overseeing for you. Many times we agree with your other consultant on some of their views in the market. Other times I know we don't, but their portfolio is their portfolio, and their investment advice in terms of asset allocation is theirs, on theirs.
Okay, it seems like in the past there's been combined performance shown for the total portfolio that you people put out. Is that correct?
That is in there. That's on the report. Yeah, earlier page.
Okay, and then could you go one step further and show your performance for that time period, break it out separately so that you can show what you have done for the period of time? And I would hope it would be greater than 6 months or 2 years, but.
That's what I gave. That's the first page that I touched on. That's what I gave you. I
Okay.
didn't show you the combined. I know you were going to hear from your other consultant on their performance. But yeah, the page I gave you earlier on where I talked about performance in the third quarter, year to date, and then I updated that through yesterday, that page had all that information on it.
Okay, previously, am I mistaken that there had been a combined statement that you all put out?
You're not, no, you're not confused. I told you, yes, that's true. It was a page or two before. What normally happens is that you want to know what we did. So yeah, I figured you might have reviewed the packet and the information that was in there. So because you have a long agenda today, I didn't give you the combined number, but it's in there. And then I did give you our numbers.
Okay, and then the last thing, in letting us educate ourselves on real estate investment trust and different styles of investments, I understand that we should understand what those investments are. At the same time, for us to make a choice and say, after we do our study, saying, yes, this makes a lot of sense to us, let's do it. That seems a little out of whack. I guess I would we should understand it, but more have it come from you than that this is what you're recommending, as opposed to us going to you saying, we'd like to get a certain percentage of our money into real estate trust.
So this is our second crack at, an asset allocation study this year. I know we were a little delayed because of the COVID. What we were trying to do, or I was trying to do through the last one and then this reiteration of it, was let you know, this is, to solve the problem of getting you the returns that you need over the next 5 to 7 years. Our recommendation is for you to start looking at some of these alternative asset classes. And to do that, the first step is that, we want to make sure you understand them, and we need to do so. Yeah, that is our recommendation. That's why I went through and kind of said, look at the differences in return, look at the differences in risk, look at how it improves your Sharpe ratio. So before you would waste your time conceivably using asset classes that don't make any sense, we wanted to kind of narrow it down. So you could look at some of those mixes to the right, and you can see some of those asset classes that, we would be recommending you get some education on and decide whether or not you're comfortable with them in the portfolio. Because they would be helpful.
The education would come from you all, or how would we get the education?
So what I've typically done with other clients is we initially do some education with you so we can cover as much ground as possible. Once you've gotten kind of a basic understanding of those asset classes, then I look for input from the trustees. Because, for example, I did a meeting like that with another board of your size, and they looked at private credit, private equity, and private real estate, and decided they didn't want to move forward with private credit. So we eliminated that. The other two, they've got a meeting coming up here, I think in another week or so, and we're going to actually bring managers in, not to make a sales pitch, but to talk to them more specifically and in greater depth about the two asset classes they were comfortable with, and that was private equity and private real estate. So it's kind of a two-step process, but anywhere along the line, and even today, if there's an asset class you see in there that we're recommending that could be helpful to the portfolio and you're not comfortable with it, this is where we're looking for your input to say, I don't care how much you educate me, I don't like this asset class. We need to know that, because there's no sense in, taking those steps to learn more about these asset classes and potentially add them into the portfolio if it's something that you're not ever going to be comfortable with.
Okay, thank you.
Sure.
This is Gordon. I have a quick question.
Sure.
Yep. I just wanted to make sure that we didn't need to make any changes to our investment policy statement to allow us to invest in these alternatives. And if we do not need to make any changes, what is the bracket? What is the max percentage we're allowed to go into our alternatives?
Good question. So you don't want to get the cart ahead of the horse, right? So one thing is you do have some alternatives already. So you're not going to have to do education on REITs. You already have it in your guidelines. Your target and ranges on that might change based upon, the outcome of some of this educational work. With some of these other asset classes, though, it would have to be added into your investment guidelines. And what we would do is, as we kind of narrow down what you are and are not going to be comfortable with, what does and does not make sense from an asset class standpoint, then we're going to come back to you at some point, show you that mix, show you targets and ranges, and then we'd have to update the investment guidelines, and then we'd have to start, allocating to those by finding managers in those spaces. So it's a process. It's not something you're going to snap your finger and have happen overnight, right?
Thank you.
Mm-hmm.
Tim, I have a question and a comment. This is Mark. First, I'm all in favor of education. And my second question is, excuse me, I apologize, but I'm burdened with some expertise in land development and economic development and city planning. And so this question is about real estate and REITs. And I know it's a small amount that we have now, so it's not such a big deal. But the real estate industry before COVID is in a big shakeup right now. Major retailers are going out of business. Obviously, everyone buys stuff online. Corporate headquarters were going strong in the major cities, but then when COVID hit, we probably had 3 or 4 things happen. It was a further attack on the retail industry, empty office buildings because the workers aren't there. We don't know what exactly is going to happen because the leases are still in place, and that could really affect us because property values go down, then we get less tax dollars as a city. The last point about that, it seems like there's a lot of unknowns, and it's kind of a scary thing to be, investing in real estate, and it's going to play out over time. It's not going to be immediate.
Right. Yep. Those are all really good points. In fact, right now you have REITs. We haven't come in and said you should tactically add more to those. If you remember earlier in the year, we had some discussion where we said we were telling folks to add when the market, tanked in the first quarter. We were telling investors to add into small and mid cap and into large cap growth. It was a scary time then, but we felt we had enough information to say valuations there were compelling. And for those that were willing to allocate to those areas, that's worked out really well. I will tell you, even if you added in private real estate or decided to add more to REITs in your portfolio, our firm tactically right now is saying, you're right, there's too many unknown variables. The dust hasn't settled quite yet enough on real estate. So we are not tactically telling anyone to add money into that space. I actually have a trustee on another board who wants to put money in REITs and is quite upset with me because I tell him tactically, we're not telling anybody to do that yet. We don't want to, right? We need more information to feel comfortable. Valuations are pretty compelling. We just want to be sure before we start adding into those areas, right, that it's the timing is right, because we still haven't fully gotten through, this COVID situation that we're all having to deal with. So good points you made, and we couldn't agree with you more. It's an asset class that has some good numbers going forward, but when you get in is going to be an important entry point as well. Any other questions?
Tim, did you have anything to add as it relates to on the agenda here, I'm looking recommendations to raise funds to reimburse the city. Did you have a proposal for that or no?
I believe it's in there. I may have missed it on the page number, though. I apologize. Some rebalancing within the portfolio. It may have been on that one asset allocation page that I was reviewing with you. Which would have been, I believe, page 49. Rob, why don't you go on with the call? I'll specifically find the page, right? And come back to you before the end of the call. Okay?
Okay. All right, just for the rest of the board members, the VFIP wanted to hear more about these different educational tools and stuff like that. So the idea would be that we would try and find a special meeting time to meet with the VFIP and with this board to learn more about some of the items that we need to be educated on, just as an FYI. All right, UBS, you guys are up. Becky.
Okay, can everybody hear me? I had to unmute myself. Okay, Shazia, let me try and find the first page for us. Unless is that something easier for you to find as you tab?
Becky, so Dave from IT is going to pull through the
Okay.
pages.
Okay, it's. Okay, well, I'll start talking. Darren, do you want to maybe interject when you find that page number? So first of all, hello, everybody. It's been a few months since we've all been together. I hope that everybody's family and that all of you are well. Sounds like you've had some COVID cases, maybe not personally, but certainly has affected your workplace. I just wanted to say to all of you, thank you for all you're doing, especially those of you that are out on the front line. I know it's been a really difficult year. And
Hey, Becky?
Yes.
Hey, Dave, it's page 175 on the presentation starts. UBS's. Go ahead, I'm sorry.
No, that's okay. So I just wanted to say thank you to all of you, and any of you who are veterans, thank you for all of your service and all that you've done. It's been an interesting year. We would say the UBS portfolio has actually done very well given how much volatility we've had and everything that's gone on. The performance, I think, has been quite good and really has exceeded your benchmark that we adhere to and has done, we've had good performance. Interesting year from the standpoint of COVID. I think that things are looking so much better. We're all relieved this week to find out that Pfizer has a drug that might be 90% effective. At the same time, we're seeing much better therapeutics. I think we're learning how to treat this disease. So while the numbers are skyrocketing, and I hope everybody continues to be careful, it seems like the percentage of people passing away is coming down. However, certainly every person that has experienced this, I talked to a client this morning who both his sister and brother-in-law, both in their 50s, both healthy, are both in the hospital right now. So obviously a lot of pain that's happened. The election, as Tim said, a lot of volatility over the last couple of weeks. Certainly a couple of weeks ago, the market was down. Market up big last week as it started to look like we'd end up with a divided Congress. As Tim said, that is usually very good for the marketplace. We understand what's going on. We can kind of continue from where it was before, and you don't see major changes. So with a divided Congress, assuming that the Senate continues to be red, we have a Biden win, and we have a blue House, we don't see huge changes. We do expect a stimulus package will come in probably between 450 to 750 billion. We do think that stimulus package is very much needed. A lot of people are out of work, but depending upon where we fall in that range will really depend upon probably where the Senate falls. We also think that with this divided Congress, you won't see court packing with the Supreme Court that a lot of people are worried about. Some of the concern 2 weeks ago, I think, starts to go away. But I think one thing that we've learned, at least I have in the 34 years of doing this, is that you just kind of keep calm and carry on. And that if you have a well-diversified, appropriate portfolio, those portfolios really can withstand many, many different events, and certainly will withstand COVID and will withstand this election as well. And typically over time, election volatility tends to go away after the first couple of months. So we're very optimistic. We do see interest rates have certainly trended up this week, but we still see that they will continue to stay low, probably for the foreseeable future. We say lower for longer. That does put pressure on equities. However, we still think that equities look very attractive. And as Tim said, as the dollar has weakened, we see international markets probably doing better going forward. We also see emerging markets and emerging markets debt, which we've just added to in your portfolios this last year, probably doing very well also. So we are optimistic going forward. We think some of the stocks that have been left behind, small cap and mid cap, will probably do very well in the coming years. We see that we'll probably start to move. We've been talking about this for a while, from growth to value, and see cyclical companies doing well under Biden administration. But the big thing, and what we have always come back to, is continuing to have a well-diversified portfolio. And the portfolio that you have with us, both in ERS and healthcare, which we'll talk to later, is pretty conservative. You know, we've maintained that basically 70% 70% equities, 30% fixed income allocation, and continue to rebalance back to that. So we're comfortable with where we are. We're very happy with the returns that we've gotten this past year, and I'll go through those in a minute. As Tim said, they've changed some of their capital markets assumptions. We have too. We talked about this earlier in the year. We're really looking for lower returns on equities going forward, probably about 7% for global equities on average for the next business cycle, which does put pressure on the portfolio with interest rates as low as they are. So any questions on our market commentary? And again, kind of brief after you've listened to Tim, which, you know, some of our thoughts are very much the same. Any questions? No? Okay, so happy to look at the numbers. I actually have my little cheat sheets here, so I'm going to go through mine, and then Shazi, you're just going to move pages for me, correct?
It'll be Dave, Becky.
Okay. So the portfolio, as I said, at the end of September, we were actually about 33% fixed income and cash. We've been slowly raising cash throughout the year as things have been sold off.
Dave, can you move forward a page there? Go forward one more.
One more, yeah. So
There
you see,
you
we've got about $3.5 million in cash. So we do have that cash covered for you, Rob. We've got roughly just under 30% in fixed income, divided by U.S. fixed income, government, a little bit of high yield, some global and some international, and then about 67% equities. About 58% of that is U.S., and just under 10% is international. We've kept our international sleeve low because we did think with the trade concerns that probably wasn't a great place to be over the last few years, but we might be looking to increase that as time goes forward and as we get a better read on the administration as we get through the rest of the year. We have added, as you know, to emerging markets, and we think that that's a good play, especially as the value of the dollar has gone down. But the performance of the portfolio has done very well. If you look at the page before, Shazia, or
Dave.
Dave?
There you go.
Yeah, you'll see that for the quarter, the total ERS, now this includes the ERS and the NAIC portfolios combined, you were up 6.24%. The year-to-date performance for these two portfolios was up 4.92, so very, very strong performance. And 1 year, September to September, up 11.15%. So if you look across that line and you compare it to the blended index right underneath that benchmark, annualized time weighted returns, that blended index is 70% MSCI World Equities and 30% the Barclays Aggregate Bond. You can see that we've had very good outperformance. So on a month to date outperformed, quarter outperformed, year to date outperformed across the board with, since 2002, average rate of return of 8.25%. So yes, there is the question of where do you go with equities now that bonds are so low, but we still think that a strong equity allocation makes sense. And maybe you diversify that other 30%, but we still like the equity environment. Darren, do you want to comment on our change with REITs this past year since that came up in the conversation?
Well, REITs became its own sector in 2020. And what we did research on is figuring out what is a market neutral allocation to real estate and what would that entail. What we've figured out is that if you own the core S&P 500 and the Russell 2000 and the Russell Mid Cap, you're getting a proper allocation out of real estate just by holding those. You can hold them in the ETF form. So we have not taken an active position in REITs because we already hold it, and we hold it above the market weight just through our current holdings.
Hey, Darren, can you repeat if you said if you're invested in what three things again?
The SPY, if you're invested in SPY, which is the S&P Spider, the IWR, which is the Russell Mid Cap, and the IWM, which is the Russell 2000, you get the appropriate allocation in real estate just by holding those ETFs.
Okay, thank you.
Right. So just, I wanted to just comment on that because we did make a thoughtful move in looking at reducing the REITs that we have, just knowing that you're picking that up through some of the ETFs and the mutual funds that you own. And we didn't want to have double the exposure because obviously that would increase the risk. So just to comment on that. Year to date, just wanted to give you the dollar amounts through September. So year to date, the portfolio added almost $5.2 million to your overall combined portfolio. And for the 1 year trail, 11.5%. So don't have a lot of expected changes or suggestions for these portfolios, but let me just give you a little bit of a run up on the ERS. So the ERS.
Did you want to do the November 10th update?
I'll do that. I was going to go through September and then go through
Okay.
November.
All right.
So the standalone ERS portfolio, which does not include NAIC, pretty conservative portfolio. It's actually 40% fixed income, 60% equities. That actually have pretty good performance too. So for the quarter,
Dave, you're going to go forward about 20 pages. Keep on going. Keep on going. Here we go, right there.
Yep. Okay. So that's through September. So if you go one page back, Dave. Yes. So for that, you'll see, again, this is what we call the ERS portfolio. It's part of what we manage for City of Troy. This does not include the NAIC stocks. So more conservative because, again, we're not looking to duplicate those holdings that you have in NAIC. So 40% cash fixed income, 60% equities, quarter to date net of fees, 5.67% positive, year to date 425 because so year to date 12/31 through 9/30, 425. Obviously the tail end of the year was better than the first part when we dealt with COVID. 1 year trail 981. So again, even this standalone portfolio, if we were to look at it as itself, with the 60%, 40%, 60% equity, 40% fixed income allocation, still going back to 2002, has averaged 7.73%. So this alone has done very, very well. When we add into the NAIC, obviously that's the performance that I just talked to you about a couple of minutes ago, but we can look at that as well. You want to go?
That's going to be another 20 some pages forward. There we go. Oh, yeah. Back one.
Yeah. And this is almost all equities. So this year to date through, let me go back. I'm looking at September. So year to date for NAIC through September up 725, 1 year trail 1589, 3 year average 14.77, all the way back again to 2002 with about an 11.2% average rate of return. So very strong performance. And obviously you've gone through some ups and downs with 2002, 2008, 2009. But having those equities, I think, has really helped your performance. But again, I just want to reiterate that these are not overly aggressive portfolios at all. you have a good allocation to fixed income, and we've raised the cash that you need. So we're not being overly aggressive here by any stretch of the imagination. The investments that you have are good quality. We continue to review them and invest them and vet them on a regular basis. And give you October updates. So going forward a few pages.
There you go.
Yep. So one back, Dave. So this is October. Again, this is the combined portfolio. You'll see the value at the end of 10/31 was $1,012,230,000 roughly. Year-to-date performance up 391. 1 year trail 844. 3-year average 936. And again, outperforms your benchmark in every time period that you've had since 2002. So year-to-date through October, the two combined portfolios up 8.8 million, very good. As we look at through November, very strong performance through November. You're up as of last night, 10.32% for the year-to-date, 6.13 in November alone, and 14.4% for the 1-year trail. So the portfolio, we've gone through a lot this year. We've made very little recommendations and changes. We've kept the quality high, and you've had really good performance. Any questions on any of that?
Becky, Mark Calise, I have a question regarding the fixed income portion of the portfolio.
Yes.
Is your assumption rates are going to be going higher sometime in the next few years?
They will be going higher in the next few years. We don't see them going higher for probably 2 to 3. But your average duration for this portfolio is not high. We've tried to use managers that aren't long on the curve. So we've tried to be as protective as we can be without taking inappropriate risk.
Okay, I was just, as hopefully everybody knows, as interest rates go up, value of bonds normally go down. So the shorter duration does make sense, but you all don't see that for the next year or two.
Every analysis that we see is longer, lower for longer. So I wouldn't say much lower from here. You really can't go much lower, but we don't see a rise in interest rates anytime soon. Darren, you want to add to that at all or comment on it?
No, we've got our core bond funds, and then we have some strategic allocation or strategic income funds, which tend to manage the duration a little bit better. But again, we think lower for longer, and we like where we're currently situated in the fixed income market right now. The tips we added have done very well, but it is a wait and see where and when we go. But we think it's going to be some time before interest rates move up.
The nice thing about bonds is that they're protective. So even if rates do go up, we still think that they deserve a place in a portfolio because they're where people go to when the market starts to go sour. So we like the allocation. We'll continue to monitor them, and we've made some changes to the bond portfolio over the last couple of years, but right now we're pretty comfortable with where we sit.
Thank you.
Yes. So we had a few recommendations. We actually had some covered calls. Did everybody get a chance to look at those? So we continue to work and add options as we see appropriate. So the ones that we're suggesting all meet with your current investment policy statement.
That is probably about 50 pages forward, Dave.
Page 326, Dave.
Ongoing.
keep going.
Very
Oh,
good. Fantastic.
One more.
Yeah.
There you go.
One previous. So again, these are all stocks that you have, all stocks that, in the event that you sell off some of these positions, they're partial positions in the future at higher prices. We're okay with that. It allows us to then take some funds and diversify a little bit further. But for the most part, most of these options, you take the premium, you collect it, and the money, they tend to expire without being called away. That's not always true, but it's a nice flow of income for the portfolio. And again, a nice way for you to diversify in the event that things are called away. So these will, how this works, so these were priced as of last week. We will reprice these as we move into the market, but we always say the least that you will get if you move forward is the current price that we're showing you on this form. If we can get you a better price, we will. If we can't get you a better price, we don't do the option. So you kind of know what you're seeing right here from pricing from last week when we put this together is a little bit of a worst case situation on the premium that you'll earn, if that makes sense. So typically, you give your authorization if you want us to move forward with the option positions.
Yeah, Becky, I think we want to move forward with that for sure.
Okay, all right, we will do that. Okay. And then I had just a couple other things I wanted to bring to your attention. As you know, the NAIC, a portfolio, it's had fabulous returns. The ideas come from a group that gets together, does a lot of research, and sends out a newsletter on a regular basis that I believe you're all getting. I can't, because we hold the investments, we review them, but we're not managing them. We're not under contract with you on these, for those of you who are new to the organization. So we typically can't recommend buys or sells from institutions that are outside of UBS. But I do review these on a regular basis. If there are positions in the portfolio that are held that UBS has a sell on, or if it's other research that we've purchased, such as from this organization, CFRA, that has a sell on the stocks, we do try to bring it to your attention. So currently there are 4 stocks in the portfolio: Air Lease, Dave & Buster's, Ascent Group, and Old Dominion, which we did talk about before, but I just wanted to bring it to your attention that there are sell recommendations on these 4 stocks from outside organizations. See whether or not you want to continue to hold them in the NAIC portfolio.
And to add to that, and Becky, just to add to that conversation, the email that I sent the group earlier this week, both Stryker and Roper are no longer going to be followed by the AIS newsletter anymore. So we have to make a decision on what to do with those as well.
So historically in the past, and Mark, you and some of the others who have been around for a long time know this better than I, is that when NAIC stops following, you typically make the decision to sell. It's nice that you're a non-taxable organization, so capital gains don't enter into it because you've got some huge capital gains on this, especially with Stryker. I can just tell you, I'm bringing up your account on my computer right now. So Roper Technologies, you have 4,000 shares. This is kind of amazing. Your original investment was $60,000. And as of last trade today, worth about $1,619,000. So really great outperformance. Stryker, you have 13,000 shares, paid about $208,000 for that investment way back when. It's now worth $2,975,000. One thought would be is if you like these stocks and you want to continue to hold them, but you want to make sure your NAIC portfolio is pure and that you're following the guidelines, you can always take these stocks and move them to the other UBS account. Doesn't cost you anything to move them, doesn't cost you anything for us to hold them in the other account if they're companies that you continue to like, but you don't want to keep them in NAIC knowing that NAIC isn't following them anymore.
And Becky, to make your point, Claire, you and I talked about this last week. Both of those, Stryker and Roper, are followed by UBS. Is that correct?
No, actually, that's not correct. Stryker is followed by UBS. We have a neutral rating on it. Roper is actually followed by another outside firm, the same CFRA, and they do have a good opinion on it, but UBS does not follow Roper. But I have a little bit more, Darren and I, leeway on making comments to you certainly when UBS follows it, we're good with everything. If it's an outside firm that we're buying research on, I certainly have more information. So, but if you wanted to, so anyway, I guess we're just bringing this to your attention as to what you want to do with these two stocks in the NIC and the 4 that have outside sell opinions on them.
I think this might be an appropriate time for the board to talk about those 6 stocks and how we would like to progress, or to do more research on it and come back next month. Does anyone on the board have any comments?
Yes, my thought is if it ain't broke, don't fix it. I do agree that as NAIC does not follow the stocks, in the past we've liquidated and waited for recommendations in their following newsletter or their current newsletter. Both of those stocks are phenomenal. And as witnessed by the return that we've seen, they're great, but there's other fish in the pond. If we've done extremely well with NAIC, I feel we should be following them. And I personally would like to see those 2 liquidated. As far as the other 4, that's a different discussion. But again, NAIC's been phenomenal until they really stub their toe or break their ankle. I would stick to the program that we've had in the past.
So Chairman Cleese, are you recommending to sell both Roper and Stryker right now, and then to have the proceeds there waiting for the newsletter to come up with some buy recommendations? Is that what you're proposing?
Yes, sir. Yes. And again, my heart breaks. Stryker has been a phenomenal company, but again, there is time to let go, and there's possibly another Stryker equivalent out there in a starting stage. So again, I would stick with NAIC's procedures that we've done in the past.
Okay. Does anyone else have a comment or a question on that? Justin?
Yeah, I'd have to agree on this one as far as the NAIC newsletter recommendations. Reading through it, it makes sense. It's time to pull the plug. We made our money. I would have to second the motion to follow the NAIC advice and sell off those stocks. And I do concur to hold the proceeds, waiting for the investment.
Okay, sounds really good. So it sounds like I have a motion. Yep. Oh, go ahead, David.
Oh, the thing. No, I agree with Chairman and Justin. Sounds good.
Okay. So it sounds like I have a motion from Chairman Cleese and a second by Trustee Novak. Any other discussion before we call it to question? Okay.
Rob, real quick.
Yeah.
Just so Roper, being a technology company and looking at their performance, it seems to be, although they took a little hit this year, seems to be back up on the upswing. We're only recommending to sell because they are not part of the newsletter or following the NAIC. Is that correct?
That's correct.
Okay, thank you.
Hey, Kurt, are you good with that then? Is that all you, are you good with
Yeah, I
that?
just had that question. Yep. Yeah, I'm support.
Okay. All right. Call the question. Chairman Kalise,
Yes.
Trustee Novak,
Yes.
Trustee Bovensup,
Yes.
Trustee Gordon,
Yes.
Trustee Hamilton,
Yes.
Trustee Miller,
Yes.
Trustee Melzik, yes, the item passed 7-0. The next one was the one that Becky had brought up about the 4 Air Lease, Dave and Buster's, Ascent, and Old Dominion. Any conversation along those lines?
Yeah, if I could, not that I'm partial to it, but yeah, I got, again, Milt Stansberry running around in my head. You see what you see and you know what you know. Fam and I went to Dave and Buster's a few months ago. It was dead. I think they're on their way out. I have no argument with that. I still wrestle with Old Dominion though. Just looking now, even in the depths of March, they really didn't dip and they're still screaming ahead because we're shipping everything. I can't get away from that. I'm hesitant on that stock still at this time. I think they're still chugging ahead. I don't think they're done. Everything else, I'm good with the recommendation.
So Justin, if I heard you correctly, are you recommending a sell on Air Lease, Dave and Buster's, and Ascent?
Correct.
Okay. Does anyone else have a comment on that at all?
I'd like to know what Justin was doing at Dave and Buster's.
I have a life, kind of.
All right, there's a motion out there, Air Lease, Dave and Buster's, and Ascent to sell and to still hold Old Dominion. Do I have a second?
I'll support that. Looking at their stock portfolio, I don't think we're at a point that we should sell yet.
Kurt, just so I heard you right, you're supportive of selling the 3 but holding on to the 4th?
That is correct.
Okay.
Second the motion.
Second the motion. Any more discussion? Okay, let's call the motion. Let's see. Trustee Novak,
Yes.
Trustee Bovensup,
Yes.
Chairman Kalise,
No.
Trustee Miller,
Yes.
Trustee Hamilton,
Yes.
Trustee Gordon,
Yes.
and Trustee Melzik, yes. Passes 6-1. Okay, Becky, anything else you need from us on those?
No, so I just want to reiterate, we're moving forward with the options. We're selling Roper and Stryker. We're selling Air Lease, Dave and Buster's, and Ascent.
That is correct.
Okay, all right, great, thank you. And just so all of you know, we're going to continue to monitor this portfolio to the extent that there are positions that we just think you need to be aware of or research on some of your positions from UBS research or the outside research that UBS pays for, we will bring it to your attention. So just think that that's part of doing our due diligence.
Yep, and Becky, we appreciate your hard work on that, and I enjoy working with you on this, so I appreciate that. Thank you.
Thank you. All right, so that's all we have for ERS and NAIC. Take any questions, and if not, we can move on when you're ready to healthcare.
Okay. We still have, we're not ready to move on to healthcare yet. We still have one other item before we adjourn, Becky. But
Okay.
Does anyone have any more questions for Becky? We have to double back, I believe, to Tim, right? Is that right, Tim, on your sell recommendation? Or rebalance?
Yeah, look through the materials and our recommendation sheet's not there. We will get that out to you ASAP.
Okay.
In general, it was basically going to come from bonds and large cap stocks where we, you've heard my comments about valuations, but it's not in the materials. I don't know why, but we'll get that out to you ASAP.
Okay. All right, thank you.
Thank you.
All right. Anyone have any more questions on the investment portfolio? Okay.
Rob, I just have one question. I don't know if it's fair to ask or not, but is there some way that we could get a breakout every month of the returns that we've seen from UBS and from Morgan Stanley, and then the combined return?
Yes, I believe it's there. Isn't it that right, Tim? That's part of what you put together. Yeah, it's in the package, Mr. Calise. I'll work with both consultants just to make sure it's more clear, or we can do something different to make sure that you understand exactly what page it's on. Without going through the 400 pages right now, I'm sure I could find it. Tim, it's you put together yours. Becky puts hers together. Becky gives you some of your information or her information to you, and then you put it all together, right?
Correct. It's there and we give it to you on a quarterly basis. Yep.
Yeah. It's there, Mr. Calise.
Okay. Hey, Rob, would you mind, if Mark doesn't mind, would you call me Mark also, please? I feel I'm old, but you make me feel much older when you say this. Plus, I don't
Sounds good.
deserve that
Sounds
respect.
good, Mark.
Okay.
All right.
Thank you.
So the next item, we have other business. We have from last month's meeting, we have the NBC Investment Consulting contract. And when we left last month, we talked about moving forward with that contract. We've had, since then, I've had Lori Bloom, our attorney, go through the contract. She had, I think it was eight adjustments to make. We made those adjustments. NBC agreed to those. And then Lori Bloom and I were ready to execute this contract, and just wanted to know if there was any discussion before we move on to the resolution. I believe, Justin, you had some concern that you emailed the group as it relates to the purchasing, and I can speak to that purchasing. Per the Troy Charter and Code, which clearly defines exceptions to competitive bidding. There's 6 exceptions to competitive bidding. Number 6 is if in the employment of professional service, with which this is, but I wanted to also make sure that we covered ourselves and did our due diligence, as Justin, you had mentioned. And number 2 to the exception is when the council shall determine by unanimous resolution to those present to the public interest will be best served by purchase from or joint purchase with another unit of government. So council last meeting passed a resolution that we can do that. And so in the best interest of the city, and we utilize the purchases of cooperatives or joint purchases, and Troy is part of this. And this cooperative or purchasing is done in the mitten system, which allows this bid process. So the city of Troy can utilize professional services. We looked at the city of Farmington Hills on behalf of the Mitten Group. Troy's a member of this. And Farmington Hills conducted a competitive process. They received a request for proposals, advertised them in the Mitten e-procurement system. This was open and read aloud on Tuesday, July 25th at 2017 for the defined contribution, RFS, and deferred compensation Roth consultant services. Notification was sent to over 200 firms with 4 responding. The firms responding were ANCO, Heartland, NBC, and Retirement Plan Advisors. So therefore, our purchasing department, along with myself and Lori Bloom, we therefore believe that we can utilize NBC Investment Consulting as part of the Mitten Cooperative in accordance with the city charter and code. And so I just wanted to give you that information, Justin, and just didn't know if you had any other questions. As an example, the police uses state contracts, through the Mitten system for ammunition, MCO for police testing, which they had a bid waiver on, et cetera. So this is very common within the city, and it was.
I get
council last meeting.
I appreciate that, and you and I had a brief conversation. I apologize if there was any affront on that. For everybody, I'm sorry I missed the meeting. I've been trying to get into that guy's training for the last 8 years, and he finally showed up. So I was glad to make that. Sorry I missed that meeting. If the other 6 members of the board said it's good to go, and that's your vote, obviously I wasn't there. I'm just obviously trying to do my due diligence and make sure I'm not missing anything for the benefit of everybody and for transparency. If this is the case, then we won't waste any time. I'm good. Questions answered. We'll just move forward.
Okay. All right. Does anyone have any other questions or discussion?
Rob, Mark C. here. Just, are we changing the investments or are we changing the advisor?
Sure. So today we don't have an advisor, and that's what we're going to be hiring. With the help of NBC Consulting, we're going to go to ICMA, who is our record keeper, and ask them to, one, change the investments that the employees will have, or the participants will have a right to invest in. And secondly, we're going to negotiate lower rates and fees. So we believe that today that we're paying 70 basis points on average, and we're going to lower that to 31 or 32 basis points for the average participant.
Rob, this is Mark M.
Yeah.
In a way, ICMA RC kind of has a monopoly on local government 401s. And this is just a way for us to apply pressure to ICMA RC to reduce their fees and give us more options. I mean, basically, we might even have to get to the point where we say we bid it out if ICMA will not be responsive in their requests. Is that correct?
Very much so. Right.
Okay.
I was successful doing this 3 years ago in the city of Warren, and ICMA doesn't want to lose our over 100 million in assets, so they'll be more than happy to go through this process with us. Kurt.
Rob, just a reminder, it's still the intent to pay for the service through what ICMA, as people left that were not fully vested. We have some monies in ICMA that could fund this. That's correct?
Correct. We have over 2 years worth, and over the next couple of budgeting budgets, I'll be talking to Mark Miller, and along with conversations with council to discuss about whether this ultimately should be a City of Troy expense or an employee expense. If you want my opinion now, I just as these UBS and Morgan Stanley are paid through city funds, I believe this should be paid through city funds too, but we at least have a couple year budget retrieval from that. Anyone else have any questions?
Yeah, Rob, this is Mark Miller. Just to clarify, those funds are when people who have vested have not fully vested. So therefore, they do not get the city's contributions.
That is correct. Yep. And so what we utilize them for, the city, is then at every so often what Lisa and her team will do is say, hey, instead of cutting a wire over to ICMA, they'll say to ICMA, hey, we have all these forfeited funds, utilize those. So that's what we use these funds for in the next couple of years. All right, so if you don't mind, I'd like to read in the resolution: the City of Troy Employee Retirement approves the attached qualified plan account application and service agreement, inclusive of amendment number 1, and authorizes the Secretary, Treasurer, Administrator to execute the document on its behalf.
Or Kurt.
Okay, there was a motion and a support. Any other further discussion? I'll call the question. Trustee Malzak, yes. Trustee Bovensup?
Yes.
Chairman Calise,
Yes.
Trustee Gordon,
Yes.
Trustee Novak,
Yes.
Trustee Miller,
Yes.
and Trustee Hamilton.
Yes.
Thank you, everybody. And I believe that's it for this meeting. So we'll adjourn, and I think we'll need to start up the next one. Does anyone need a 5, or are we good to go? Looks like
Bob?
we're gonna, yeah,
This is Mark. I told you earlier, I have to head out to a 3 p.m. meeting. So if I have to bug out about 2:20, that's what I have to do.
okay. All right, we promise we'll have you done by then. Okay. So roll call we have, and I can see Chairman Calise, Trustee Gordon, Trustee Bovensep, Trustee Novak, Trustee Malzik, Trustee Miller, and Trustee Hamilton all here. So we have perfect attendance. Again, there's two, we have resolutions that were put in. We're moving from an emergency order to legislation. So I will move that the 2 resolutions as printed. Can I get a second on these 2 resolutions? Second from Trustee Hamilton. Okay, call the question. Trustee Malzik, yes. Trustee Hamilton?
Yes.
Trustee Miller?
Yes.
Chairman Calise?
Yes.
Trustee Gordon?
Yes.
Trustee Bovensep?
Yes.
Trustee Novak?
Yes.
Thank you. Okay, public comment, there was none per shots. Yes, that's good news. And then, has everyone had a chance to look at the minutes? Can I get a motion and a support?
So moved, Kurt.
Second, Mark.
All right. Any discussion? Okay. Roll call on this one as well. Trustee Bovensep.
Yes.
Trustee Miller.
Yes.
Trustee Novak.
Yes.
Trustee Hamilton.
Yes.
Chairman Calise.
Yes.
Trustee Gordon.
Yes.
And Trustee Malzik pass. All right, minutes are good. First item, board, regular business, board meeting dates. There is it's still a quarterly meeting, and there's 4 meetings, and it's the second Wednesday of those 4 months. Does anyone have any questions or concerns? And if not, can I get a motion?
So moved, Kurt.
Thank you, Kurt.
Second, Mark C.
Mark C, second one. All right. Any further discussion? Okay. Trustee Bovensep.
Yes.
Chairman Calise.
Yes.
Trustee Gordon.
Yes.
Trustee Novak.
Yes.
Trustee Miller.
Yes.
Trustee Hamilton.
Yes.
And Trustee Malzik. It passes. All right. Next thing is the actuarial engagement letter for 2021 with GRS. And again, this is very similar to last year. Just so you know, in this one, this is for retiree healthcare. By state law, we only have to do this every 2 years. So last year we didn't have one. This is the year of that. For the year ending December 31st, 2020, we do this. So this one's done every 2 years. And other than that, there's nothing too special about this.
The VFIP and the ERS both are every year, right? This is the only one that's every 2 years?
That's correct.
Okay, thank you.
You're welcome.
I'll move the engagement letter.
Great.
Support Novak.
Support Novak. Okay, call the question. Trustee Hamilton.
Yes.
Trustee Novak.
Yes.
Trustee Miller.
Yep.
Trustee Bovensep.
Yes.
Trustee Gordon.
Yes.
Chairman Calise.
Yes.
And Trustee Malzik. Yes. All right. Becky, I got through that pretty quick. you're on.
Okay, just unmuting myself. So hi, everybody again. So still have Darren with me. So Darren's going to spend more time with us this time around, but let's get started. And as you're looking at the piece that Shazia sent out, if you want to look at our performance for the year and historically for the healthcare plan, you'd be looking at page 15 of 261, I believe.
Right there. Where is it? Is Dave still here?
Yeah, I'm bringing it up. Though,
Okay.
Becky, would you like me to make you the presenter so that you could bring it up and go through? Because I don't have the, I don't have the page number, so it's.
Oh, you know what?
difficult
No, truthfully, no, because I'm working off my UBS screen and then I'm talking on my iPad, so it'd be kind of impossible for me to do that. But I don't really need a lot of it, so I just we'll look at this page and then I think we can work through it if that's okay. So this is for September, and we'll go through October returns, then also give you a November update as well. Okay, so one page before that.
One more page.
Right, perfect, right there, yes. So this gives you the snapshot on the quarter to date ending September, year to date, 1 year, 3 year, 5 year trail going back to 2013 when we started. And then underneath the benchmark line, the second one is really the benchmark that we adhere to, which is 70% MSCI World, 30% Barclays government credit. So you'll see that for the quarter, June through September, very good quarter, up 6.01% net of fees for the entire portfolio. So you ended up the quarter in September at 100 million, just a little bit above that. Year to date, again, the quarter ended up doing much better, or the year toward the end of the year than the beginning. So year to date, December 31st through November 30th, up 4% net. And then the 1 year trail, so September to September, up 10.61% net of fees. 3 year up 8.05, 5 year average 9.56, and going back to inceptions, average of 6.76. And as I've said that before, that inception period includes about 6 months where we sat in cash and CDs as we look to put a proposal together, get that through the system, and get everything brought in. So, but very good performance as you look versus the benchmark. So the quarter outperforming, the year to date outperforming your benchmark, the 1 year outperforming your benchmark, as the 3 year, the 5 year. The only thing, and even the inception. So even with that cash that we held, net of fees, still outperforming that benchmark. So, and that's with a 70-30 allocation. Many of you may remember that at one point in time, we were a 75%, 25. There was some thought, Rob, about a year and a half ago, time's gone so quickly, but when Tom was still here, we did look to take some money out of healthcare, no longer doing that. So probably coming to you in the early part of 21 and perhaps increasing that equity allocation as we're building versus taking. Didn't want to make any big changes this year. We've been a little concerned about COVID, obviously, and then the election. It looks like both will end up being good for the market. So we'll probably look to make some changes. But
yeah, and Becky, I think I agree with you because we're in several more years yet of net contributing to it versus, like you said, taking away. So that makes a lot of sense.
Good. So we'll talk about that in February and come back with a revised allocation for you. I think that makes sense. But year to date, through September, up over $4 million in this portfolio, which is great on a $100 million portfolio. And for the 1 year, up almost 9.8 million. So again, very good performance. And I really appreciate how easy it is to work with all of you in that you don't get overly rattled with markets and ups and downs. And I really do believe just being calm and carrying on and sticking to a well-allocated portfolio has helped you significantly. And as you know, this is, we are under an institutional contract with you under healthcare. So we are charging you a fee as which is different from how we manage the ERS money, but they've both done well this year. So we can go forward a little bit, and unfortunately, I'm probably not going to be able to give you the exact page, but I can give you the performance through October. Performance through October, the month of September was down 0.9% net of fees, but still making the 1 year positive at 3.06, 1 year trail still positive 8.01, and interestingly, still outperforming your benchmark across the board. So by a pretty good margin with that 70-30 allocation. November has been great. The market responded to the election and probably a divided Congress. So it looks like the senator from Alaska has won or has been, that vote tally is in. So that probably makes that divided Congress even more assured as we've been sitting here. But for November, the portfolio was up 9.71% year to date through November 10th, and the 1 year trail up 13.87%. So through November, you're up in this portfolio about 9.7 million and up 13 million from the past year. Again, a pretty volatile year. So Darren's going to go through our managers. For the most part, we love our managers. We're coming to you with one change. We scrub these regularly. We look to see how their investing has changed. We look to make sure that the same people are there. And if we've had underperformance that we can't explain, that doesn't make sense to us, it's pretty easy for us to change out, again, because you're under a contract. So Darren, you want to take it away?
Yeah, Dave, you're going to go forward about 15 pages, I'm guessing. Keep on going. And okay, so you have three separately managed accounts. One is Loomis Sales Large Cap Growth, which has done very well. The next one is the MFS Large Cap Value, which has also done well. And I will not go into much detail because there's not much to report there other than they're performing in line. The other separately managed account is your FCI Fixed Income, which is your corporate bond manager, also doing very well. So if we go, Dave, probably another 8 pages, we'll get to the mutual funds and ETFs. Keep on going. Keep on going. Yeah, keep on going.
Stop.
And then we'll go. So, yeah, there we go. So we added tips in 2020, and it's been a very good investment. It's up over 8% since we purchased. We use the ETF in this space because there's only a limited number of inflation-protected treasuries, and we believe buying the index is the best proxy for performance in this case. So you can go forward, Dave. Keep on going. The next one is Blackrock Strategic Income. You can stay right there. This is our strategic income bond fund, and what you find versus the Barclays aggregate bond. And this is a risk return and also upside downside capture ratio. What we find is this bond fund has much less risk, has a smaller return profile, but we like it in the risk return trade-off. It captures about 80+% of the upside and doesn't capture any of the downside. So we like this from an insurance standpoint. Go forward.
Can I just interject just a second back to Mark Kalisa's comment or question from before on the average duration maturity? So for this fund, it's 2.92. So pretty short term. So trying to be, again, as conservative as we can be in the event that rates go up.
And it has a yield above 2% at this point. So we can go forward. Next one will be Blackrock High Yield. Also a very good fund. We compare it to the Bank of the High Yield Master benchmark, and what we find from a 1, 3, 5, 10 year, and since inception, his rank is well above the 50th percentile. So we like it from that and the risk return trade-off going forward. A couple pages forward. This is the Emerging Market Income Fund. Yield is above 4% in this case. Has had some slight underperformance on a 1 year, but on a 3, 5, and 10 year, still very good performance versus the benchmark. Again, we like it based on the yield. We can go forward. Keep on going. This is your ETF, the S&P Spider. We don't need to go through this. This is just a benchmark, an index ETF. You'll see it's right on. This is a fund, Janus Henderson Enterprise. This is your mid-cap growth fund. This is a fund we're suggesting making a replacement in. Had a very long discussion with the portfolio management team. You've had a great return in this mutual fund. You're up over $1.4 million, which is about 67% holding period return. But going forward, they are going to have a lower allocation to technology, and they will not change their methodology to adjust. So we're making a suggestion to move to a different manager at this point. And I'll go over that fund at the end. So go forward. Russell Mid Cap. Again, this is going to be a proxy for the index. Go forward, Dave. Russell 2000, the small cap ETF, will go forward on this one too. John Hancock Disciplined Value. This is your mid cap value fund. And we go one forward from here. And this looks at the return versus the Russell Mid Cap Value, and it's right on that risk return horizon. And we like it from the upside downside capture trade-off. We'll go forward. Next couple pages here. MFS, a new discovery value. This is your small cap value. What we see on the rank on the 1, the 3-year, 5-year, 10-year. 10 years not registering because the track record does not go back, but on a 1, 3, and 5-year, its rank is 27, rank number 1 in percentile, and the 5-year number 1. So we like this fund, and we'll continue to hold it. Go forward. Virtus KAR Small Cap Growth. This is a closed fund. It's closed because of its extreme outperformance versus the benchmark. You'll see on the 1, 3, 5, and 10 year. On the 1 year, its rank is 17, 3, 5, and 10. It's ranked number 1. They closed the fund because they wanted to protect the manager and his philosophy, his or her philosophy. And you will find that in funds that do very well. They'll shut them down to new investments so that the process is not competed away in the market. Carry forward. This is your benchmark international. This is the MSCI EFA ETF. We can go forward on that. And then we have MFS Intrinsic Value. This is your large cap growth portfolio. Great performance, long-term rank on a 1 year, 38, 3-year rank 13, 5-year rank 16, and 10 years still ranked number 1. Great fund, close to new investments. We'll continue to hold this one, go forward. And then we have ClearBridge International Growth. That was the fund we replaced Euro Pacific with. Just the prior meeting. Continued good performance. Rank on a 1 year, it's 37. Rank on a 3 year, it's 12. Rank on a 5 year, 7. And in the 10 year, it's 1. We'll carry forward. One page. This is performance versus the benchmark. Apologize, I don't know how to stop this. There we go. Whoa. Can you still hear me?
A lot of echo.
Shoot. Hold on one second. Is that better?
Yes.
Yeah, you're good.
Okay, sorry about that. I had my outside phone ring here. So ClearBridge International Growth, this is the risk return trade-off versus the benchmark, and you'll see it's above the index and less risk. We like that. Quick fund, carry forward a couple pages. American Fund Small Cap World. Another good fund, performance on a 1, 3, 5, and 10 year, all at or below the 25th percentile, which we like. Carry forward. And then the American Funds New World, this is your emerging market fund. Again, good performance versus the universe and benchmark. Ranks very well from a 1, 3, 5, and 10 year. Carry forward. And then the final page is going to be the MFS Mid Cap Growth. So we're going to go back one page. So Morningstar, its expense ratio is right in line with the Janus Fund. It's actually 1 basis point lower at 74 basis points. What we find here on that, the risk return trade-off, which is on the lower right-hand corner, the blue circle is the manager, the red triangle is the benchmark. What you find in the 1, 3, and 5 year is that manager has lower risk and higher return versus the benchmark, which we like. We'll go forward one page. Performance quartiles, the 1, 3, 5, and 10, very good ranking. 42 on a 1 year, 16 on a 3 year, 12 on the 5 year, and ranked 10 on the 10 year. Go forward one more page. Also, from a risk return perspective, less risk, higher performance. This manager is known for their risk management. You'll see that it captures 104% of the upside. If we look at that up cap ratio and the down cap ratio. So what that means is in an up market, we would expect this fund to capture 104% of the upside. And if the market were to go down, this would only capture 88% of the downside. So not only do we look at the fund from a performance, we also look at it from a volatility standpoint and how they participate in up markets and down markets. So we believe this is a great upgrade to move on from the Janus Enterprise Fund. You've made a great return in that Janus Fund, but in talking with the manager, they're not going to change their philosophy, and we believe they're going to be missing out in returns going forward. Any
So Darren, are you looking
Yeah.
for us to approve that change? Is that what you're looking for?
Yes, the recommendation is to sell the Janus Henderson Enterprise Fund and replace it with the MFS Mid Cap Growth Fund.
And again, the difference in fees on this one?
This is the MFS Mid Cap Growth is 74 basis points, and the Janus Enterprise is 75 basis points.
Okay. Does anyone want to discuss this at all? Or anyone want to make a motion to do such, follow the recommendation of our consultant?
Yeah, sounds like a good move. It's making money and it's cheaper. I don't see the downside.
Second.
Okay, so we have a motion from Justin and a second from Mark C. Any further discussion? Okay, we'll call the question. Trustee Novak,
Yes.
Chairman Cleese,
Yes.
Trustee Gordon,
Yes.
Trustee Hamilton,
Yes.
Trustee Miller,
Yes.
Trustee Bovensup,
Yes.
Trustee Malzick. Yep. Passed 7-0.
Okay, well, I think we covered everything we wanted to on the retiree healthcare fund.
Hey, Becky,
Yes.
I have a question for you.
Sure.
In the last meeting, Morgan Stanley had mentioned about changing or looking to change the portfolio based upon, the market study and, maybe equities and fixed income wasn't going to get us there. Does UBS have that same stance or no?
Yeah, yes and no. So I would be more comfortable with that with healthcare because you're not taking funds out. But certainly when you talk about alternative investments, as you heard, you're talking about real estate. We think we have real estate covered through the managers that we use. You'd be talking about private equity and then hedge funds, basically. So private equity and hedge funds, typically much longer term investments. Private equity, you're probably looking 10 to 15 years out if you commit to those investments. And hedge funds, oftentimes you can't buy and sell them quickly. So they might have 1 year holdups, 2 year holdups, quarterly holdups. So you just want to understand the cash flow. So with healthcare, where you have money coming in and not money going out, I would be more comfortable there. In ERS, when you have money coming out, just to be aware that some of those things can be pretty illiquid. I think what we found over, and Darren, step in here, but I think what we found over the last 10 to 15 years and looking at returns for alternative investments is that private equity can do well, can do as well and sometimes better than publicly traded equity, but not by a huge margin. And then alternative investments are from the standpoint of hedge funds or fund of funds. It used to be that people expected equity type returns from those over a long-term basis. And I think what we're finding is that they're really not necessarily keeping pace with equities, but they can be a good diversifier. And when you look at the returns of hedge funds versus fixed income, we always caution people to really look at fixed income type returns. So as interest rates have gone down, perhaps adding hedge funds as a diversifier would be a good alternative. But I would just be cautious that you're probably looking at lower returns. You're not looking at the 7% averages that we're anticipating for global equities going forward. Darren, do you want to add to that?
Yeah. So private equity, as Becky alluded to, is probably the most consistent return. But you have an invest period that goes for five years typically, and then harvest. You'll hold the investment for 10 years, and then there'll be a 5-year distribution. So private equity, great long-term rates of return, but liquidity is very limited. And you're not realizing returns until probably 10 years into the investment. Managed futures, we hear a lot of color about managed futures. They have gone nowhere over the last 5 to 7 years. It's a very hard asset class right now to make returns in. Hedge funds, a little more consistent returns. But again, limited liquidity. They typically have 1 to 2 year lockup, and then your redemptions will be quarterly, but then they'll also hold back your original investment till they finally close out a year. So if you wanted to liquidate a hedge fund position that was 3.5 years in, you might be in the 4th year before you can get some of your funds back. So,
Okay. I appreciate it.
Yeah.
I just wanted to get a feeling because I just struggle sometimes. I guess it's the not knowing, and that's what, you know, Mark Miller mentioned about education. I'm all for that. It's just for me a little bit scary to start looking at private equity and private this and that, and I just don't have the knowledge of it. So, okay.
Yeah,
Does
one
anyone-
thing,
Go ahead.
I'm sorry. So Rob, I was just going to add that if it's something that you end up venturing into, we always suggest that you do it slowly and cautiously, and that maybe it's something that you look to add to over time versus, you know, taking a pretty big percentage of the portfolio and going all in at once. I think that's a more prudent thing to do.
For sure. Well, thank you.
Yes.
Does anyone else have any other business they'd like to talk about today before we adjourn? Okay.
One thing is the Christmas party, which I'm not going to attend it if there is one. I think we shouldn't due to COVID. If there is one, I don't plan on attending it because I'm not really attending anything. So my recommendation is we just don't do a Christmas party this year.
Right. I think a lot of people agree with you on that. Trustee Hamilton, I think we're going to hold off this year since we have these high numbers, and sounds like west side of Michigan's already having problems with hospital beds. So yeah, we don't want to add to it.
I wouldn't
All
mind.
right.
You could send out a box of steaks to us all and we could have our own party.
Zoom Christmas party. Yeah, I guess that's okay. But
I just want to make one comment to Mark M. The real estate, that is a questionable area right now. Some of these large corporations are not even thinking about bringing folk back until June of next year to their buildings. And if they do that, they are going to phase them in. My brother works for Capital One at the headquarters, and they started phasing in. They were going to put 5% of the staff in. They ran into problems, so they basically pulled back, and they've continued to work from the house. So real estate, hopefully Troy's diversified enough, but it's going to be a problem for a while, it appears.
Yes, agreed. All right. Well, before we adjourn, I just want to say thank you to Shazi and Lisa for all your hard work of putting these meetings together, and Dave and IT. And then also for all the board members, thank you so much for spending your time with us today so we could do the business of the city. I appreciate it. And to our consultants, thank you very much for all your good returns. So we'll see you guys all next month, and stay safe, and thank you very much.
Okay.
All right,
Happy
take care,
Thanksgiving,
everyone.
everybody.
Happy Thanksgiving.